Welcome to Daily Forex. Today we're going to be taking a look at long and short trades explained. So let's jump straight into this one. When we talk about trading, we often use the expressions long and short to classify two types of trades. It can be confusing to understand what exactly these terms mean. So in this video, I'm going to explain everything you ever wanted to know about what long and short trades mean. The simplest way to classify long and short trades is to say in any trade, you are long of that from which that you will profit if it rises in relative value, and short of that from which you will profit if it falls in relative value. For example, let's say that you buy a stock of ABC Incorporated with dollars. It can now be said that you are long the stock of ABC Incorporated and short of US dollars. This is because for you to profit, the value of the ABC Incorporated stock must rise against the US dollars. Or alternatively, the value of the US dollar must fall against the stock of ABC Incorporated. It should be pointed out that in a trade where you are short of a currency against some tangible asset, you would usually refer to that only as a long trade and not say that you were short of the cash denomination. We will talk more about that later. Another way to understand the difference between long and short trades is that you make a trade where you want the price to rise in a chart. You are long of that instrument. If you want the price to fall in a chart, you are short of that instrument. What then is a real short trade? From the time of the Bretton Woods agreements, shortly after the end of the Second World War until 1971, the value of the US dollar was defined as $35 per ounce of gold, and therefore, effectively, the price of the greenback was the same as the price of gold. Most major economic powers agreed to fix the value of their own currency to that of the greenback. In 1971, the US began a series of devaluations of the greenback compared to the price of gold, before finally abandoning all linkage between the dollar and gold in 1976. For this reason, there was very little Forex trading before the 1970s. Speculative traders instead focused on stocks and commodities. Traders could make money by buying stocks and commodities cheaply and then selling them at a higher price. However, as traders wanted to find a way to profit when they thought the prices were about to fall, but didn't already own the stocks or commodities to sell, the practice of going short arose. So traders would go short of stocks or commodities by borrowing the stocks or commodities in question and then selling them before buying them back later at hopefully a cheaper price. The stocks or commodities could then be returned to the loaner and a profit taken from the difference between the original sale price and the buyback price. It should be noted that short sellers would have to pay interest on any money borrowed initially that was required to purchase the stocks or commodities to be sold. Therefore, going short could be very different to going long. It should also be noted that stocks and commodities, but especially stocks, tend to have a long bias, meaning that their value is more likely to rise over time than fall. Falls in stock markets, or bear markets as they're often called, tend to be faster and more violent than rising markets, bull markets. This is arguably at least partially due to the fact that if you sell stocks that you've borrowed money to pay for, you are more likely to panic if the trade starts to move against you than if you own the stocks while the price is falling. In Forex, things are different because Whether you are making long or short trades, you are always long of one currency and short of another. If you buy or go long euro dollar, for example, you are buying euro with dollar. You are long euro and short dollar. If you sell or go short euro dollar, then you are long the dollar and you're short the euro. It's all really the same. The only important factor regarding the long and short trades question in Forex is any interest that you might need to pay to your Forex broker if you hold a position overnight, or alternatively receive from your broker. So this is calculated by reference to the interest rates at which banks lend particular currencies to each other, at least in theory. So unfortunately, Forex brokers sometimes use this as a very subtle way to make some extra money from their clients. For example, let's say that you go long euro dollar. You have, at least theoretically, bought euro with dollar. If the interbank interest rate for dollar is higher than it is for euro, your broker might be paying you some money each time you hold that position over the New York rollover time, i.e. daily. This is because you're getting interest on your dollar greater than the interest they are getting on euro. And in theory, positions are squared at every New York rollover. On the other hand, if the interest rate on the currency you are long of is less than the rate of you are short of, you will be charged some amount representing the difference every day the position is kept open. Short stock trades. So it is worth remembering that if your broker offers trading in individual stocks, commodities, and also stock indices, you can make short trades as well as long trades. This means you can potentially make just as much profit in a falling market as in a rising one. But when you're making short trades in stocks or commodities, be careful. So that's it from us on long and short trades explained. Do not forget that for the latest market analysis and also educational videos, download the Daily Forex app. Thank you very much.